This building right here was worth over $140 million just 2 years ago, and we just bought it for $92 million. Everyone's been waiting for the real estate market to crash, but it already is. These are the best deals I've seen since about 2010, which was after the GFC or the Great Financial Crisis, which is a very different crash, but this is a little bit different. What's happened here, interest rates went up so much that it also made capitalization rates or cap rates also go up, so it devalued these properties when you start to look at it. Even though the rents have gone up, expenses have gone up too, but even though this property is not crashing internally, it's not imploding, in other words, it's not high vacancy and it's not out of control. It's just that the values have gone down because interest rates went up and people decided they didn't want to pay as much for these because they're looking at cash flow. Don't forget, interest rates create mortgage payments, and higher interest rates mean higher mortgage payments. Higher mortgage payments mean less cash flow. So when you're solving the cash flow, which is the only reason to buy real estate, you're automatically going to offer less because you have to offer less to get more cash flow. So that's what interest rates did. And as a result of that, we started to see values go down and capitalization rates go down. So even though this property is beautiful, brand new, just a few years old, it's actually $50 million less than it was just 2 years ago as a result of that one issue. So the story of this deal is like any other deal, where it starts with a relationship with the brokers locally. In this particular case, this property had been listed, it had actually been appraised, and there had been a partner buyout. Because our acquisition team is constantly in contact with, some of the local brokers, like any market, there's always several brokers that are kind of controlling the market. It doesn't really matter where you are, but there's always the top 20%, let's say. So as long as you're keeping track with those folks and trying to figure out what's going on with that particular market, you can see whether or not it's going up or going down. And in this particular case, we felt Las Vegas was too hot. In other words, several years ago, like all markets, it was growing like crazy. And as you guys know, we decided not to buy. So we just sat on the sidelines. But then when interest rates started to go up, and cap rates started to go up, then values started to go down because the mortgage payments grew. So the same property at a higher price with higher mortgage payments, it wasn't penciling. So because you still had your rents and your income minus your debt, but the debt was growing. So when debt goes up, cash flow goes down. And so in this particular case, all that has to happen. There's a little bit of a lag that always happens as a result of that. So the price of the property started to drop because the interest rates went up and people were willing to pay less because the cash flow was less and less and less. So we just waited through that period of time. Property like this operates very differently than a single family home. A single family home, you have an individual trying to buy a house based on what they can afford, what their mortgage payment's going to be based on what they make. On a property like this, what you're looking at is how much people are paying every single month in rent, what your vacancy is, what your other income might be for things like garages and pets and things like that, minus all the expenses. And that's what's called your NOI. So your income minus your expenses. So the bank looks at the NOI, and then from there, they size the kind of loan that they can put on a deal like this. And so as these prices started going down, it started to actually be better and better because now with the higher interest rates, it starts to cash flow again, just like we would have wanted years ago. One of the reasons that we haven't bought in the last several years was because when interest rates were low, people could afford to pay more. So because they were paying more, the prices were going up because interest rates were low, and the cash flow was good because the interest rates were low. But as interest rates started going up, all that did was reprice all that nonsense and what I would call a bubble that happened from the prior 2 years. So what you're standing here looking at today is a property that's priced appropriately. And what we stayed away from was buying during the bubble just 2 years ago. So while the price was over 142 years ago, that was at its peak. That's not when you want to buy either. That's not even what it's worth today. So just because it was over $140 million doesn't mean that it'll ever even get back there. The point is that we bought it today at $92 million. It cash flows right out of the gate. And of course, we have operationally lots of things that we're going to be able to do to grow the value. And then if and only if interest rates go down, if and only if there's a big demand of people still moving to this area and it's pushing the rents up, then of course we're going to see the value go up. And so we believe that we bought it at a phenomenal price, well below replacement cost. So probably $50,000 to $60,000 a unit below replacement cost. So we bought this at least $20 million below what it would cost to build it today, but also it cash flows on day one. We feel like because we bought it below replacement cost, 2, there's room inside of the rent roll to grow the rents, and 3, there's no new construction in this area, and 4, we bought it at today's interest rates and it cash flows. We think this is going to be a heck of a deal moving forward. So the real question is how can anybody like you find deals like this? And I'm telling you, I'm no different. So all you got to do is be in the market and understand what's happening. So just because you can and just because you have the money doesn't mean you should buy something. If you're connected with the community and you're connected to the brokers and you're connected to the area and you know what you want, then you'll be able to see, just like you would if you were buying a house, you'll find neighborhoods that sometimes people want to be in and sometimes they don't. And when there's a lot of demand in the neighborhood, then the prices go up. And when there's no demand in the neighborhood, the prices go down. So it's the exact same thing. This just happens to be a multifamily property in the middle of a neighborhood that has obviously all kinds of really good things, like really good shopping like Whole Foods right next door, and $1 to $3 and $4 million homes across the street. You start to look at that, you start to see better school districts, you start to see better rents, and you start to see better occupancy. So all of those things are important. The one thing that drives a property like this is employment and population growth. So you might know that Nevada, specifically Las Vegas, was the leading city and state for population growth and employment growth in 2023. So obviously you need people to be able to rent these kinds of things. No people, you have vacancy. A lot of people, you have very little vacancy. And so that all translates into value. So at the end of the day, you can buy a property like this on the edge of town that nobody wants to be in. You're going to have a horrible experience. But if you buy it like this on an infill location, you're going to find that the experience could be very good. So when you find apartments that there's a lot of demand for and there's not a lot of vacancy, then those are the kinds of markets that you want to buy, because that's going to push your rent gradually over time based on the demand. It's the same thing with a restaurant as it is with a hotel or it is with an Airbnb. If you're in the area where people want to be, then of course you're going to do really well over the long haul. But if you're in an area where people are leaving, then it's not going to be so good. The old properties usually have cabinets above and the low kind of short counters. And so now you'll notice one of the things that we do, especially on the older properties, is we'll rip out these cabinets, open up the kitchen, and then do the bigger counters, because this is where people eat now, right? They put bar stools here. So you notice this unit specifically doesn't have a dining room. Like a lot of the old school ones had the dining room with the light hanging down. So people are kind of moving away from that. They sit up here with the computer, they eat here. So this is kind of the new thing that you'll see in a lot of the newer developments. And then I think it's important to see like the technology that started off in really high-end homes. It always starts in custom homes, always. The cameras, the smart home, the thermostats. But now they've made their way into the Class A apartments, and now actually they're going into Class Bs and Cs even on the retro. So you got Alexis, then you got the thermostats, and then you've also got alarm and everything over here. So the smart home's a big deal. So all of that stuff that starts in your home makes its way down every single time into apartments. First, it starts at the high end, and then it'll start to work its way into the B's and C's. Real estate investing has not changed at all. The math is the math. What has changed is the price, the construction costs, the interest rate, inflation, what people make, all that stuff has changed. But the actual purchasing the property, the lenders, they're all the same. You know, people, there's still debt, there's still equity. There's just the math. The math is what is the total rent minus the expenses, minus the debt. Does that equal cash flow or not? It's the exact same process. Whether you have an Airbnb, you have Airbnb income, you have Airbnb expenses, and then you have debt on it or not, and you have cash flow. That's how the whole thing works, except with this property, it's just 347 units. So it's just the same, a little bit different, obviously, but it's the exact same thing each time. Yeah, this is not a one-of-a-kind deal. Obviously, there's a lot out there like that, and what you're trying to find are sellers that are trying to sell. What happens a lot of time is sellers are always looking in the rearview mirror. They're saying, oh, this is what my property was worth, so I'm going to hold the line. So you have a lot of those, and then you have others that are like, I'm just going to take my losses in case it goes down more, and if it does, I'm going to sell. That's certainly something that could happen. But in our case, if the value goes down, we still have the cash flow because we have fixed rate debt. So as long as we can keep our occupancy up and our expenses in control, we know what our mortgage payment is going to be each and every month. And so for us, it's, again, we're playing the long game here. So this is a property that we're going to hold for a long time. It's a Class A building right in the middle of an incredible location. When you find something like this that cash flows like it does, you want to hold on to it. The whole point of this is to have the tenants pay off your mortgage and to have a cash flow. That is the entire point of buying real estate. I do think that the market potentially could go down more for a few reasons. One, there's a whole lot of units hitting the market right now on new construction. So new construction that got started 2 years ago when construction debt was less. If you started building something 2 years ago, because we certainly did that, 2 years ago, we started building things. Well, new construction went up, let's say the interest rates were 5%, they went up over 9%. It's very possible that the market's going to remain soft for about a year to 2 years based on all the new construction that is hitting the market right now. So right now, depending on the market, you're going to see a tremendous amount of new properties being delivered that got started 2 and 3 years ago when interest rates were low. So you always got to go back to that point of when interest rates were low, what happened? People started refinancing, people started buying houses. Well, and if you're building something like this, it could take several years. It's being delivered right now. So now the tenant has a lot of choices, which is good for them, and it actually hurts the operations. Because now a tenant here has lots of options. So that's why when we decided to buy this property, one of the big things we wanted to see was how many units are under construction in this particular submarket. Because there are some submarkets that we look at where you might have several thousand units actually leasing up and opening right now today. And what happens is the tenant has lots of choices. So the tenant can go, for example, say, I can rent a 2-bedroom apartment, but over here I might get a month free. Or over here I might get 2 months free. And that happens as units get absorbed and as brand new units hit the market. So that's going to create softness for the next year to 2 years, which is totally fine. That's when you want to buy. You want to buy when operations are down. You want to buy when revenue on a property like this is down. You want to buy when operating expenses are up, things like marketing. So those are the kinds of things that you look for. You want disruption when you're buying. And so we're trying to buy in this, call it a year to 2 year period of time where there's potentially disruption. You want to buy for what the property's operating at today. So we're in the process of buying $1 billion of real estate just like this. This one's just under $100 million. And if you want to take a look at some of those deals, just click here. I'm sure, like a lot of you have heard of buy low, sell high. Well, in my particular case, like everybody wants a deal, like on everything they do, whether it's buying a car, or renting a place, or buying a house. That's human nature. So for us, when I take a look at the apartment market, I think this is the time. The reason this is the time is because we have hundreds of thousands of units hitting the market right now, and that's going to create softness. And so when you start to see vacancy and you start to see concessions and you start to see income going down for an apartment project, then all of a sudden the NOI goes down, the value goes down, and that's when you want to buy. What you want to do is you want to buy when the cycle's going down. So we've already seen interest rates drive values down. We've already seen capitalization rates go up. And now what we're starting to see is higher expenses in the form of insurance, property taxes, and marketing to try to keep the properties full. So that's the higher expense side. But on the income side, you're going to start to see less rent growth. You're going to start to see concessions, and you're going to start to see less income brought in from the partnership or a property like this, because the tenants are going to have a lot more choices moving forward as the new construction gets delivered all over the country. So you've got a hit on the income, you've got a hit on the expenses, you've got interest rates at very high numbers from where they've been historically, and then of course you already have values that have dropped. So when all those things are aligned, you want to swoop in and buy when the property values are already down. You want to buy on today's income and expenses and then ride that train all the way through that period of time and let all those units get absorbed. Because in 2027 and 2028, which might seem like a long way out, you're going to see a huge shortage of units. So what you do is you buy when things are soft, and then you wait and you cash flow until that period of time. Then you take advantage of refinancing or lower debt or whatever it might be in 27 or 28. So that's the whole plan. And by the way, that's only 3 or 4 years from now. So for a lot of you, that might seem like a long time, but we typically like to hold properties 8, 10, 12 years. And so this will just be the next cycle. So buy when things are soft, manage through it, make sure you cash flow, and then take advantage of things when it starts to tighten up again. So as I was just saying, our company, MC Companies, is planning on buying $1 billion of real estate. If you want to see exactly how we're doing that, click here.